You've probably heard that a strong dollar means a strong America, right? It's like the backbone of global finance, keeping your savings safe and ensuring you can grab that morning coffee without breaking the bank. But what if that backbone is starting to wobble? Imagine waking up one day to find that the system that put the dollar on top is slowly being pulled apart. It could seriously mess with your retirement savings and even the price of your favorite latte. Think about it. If the dollar loses its grip, everything from your paycheck to your grocery bill could feel the pinch. It's a wild thought, isn't it? How would that change your day-to-day life? Today, we're going to pull back the curtain on why the US dollar is losing its grip on the world stage. This isn't just a headline. It's a fundamental shift with profound consequences for everyone. But before we dive in, if you enjoy videos that connect the dots between global politics and your personal finances, make sure you subscribe because we have a lot more to explore together. And tell me in the comments, what country are you watching from and what's your biggest concern about the global economy? I'm genuinely curious to see the perspectives from around our planet. Let's start with a simple yet powerful question. Why are countries around the world, from old rivals to longtime allies, suddenly looking for ways to trade without using the US dollar? The answer isn't just about politics or rivalry. It's about a deep-seated loss of trust, a story that begins not with a bang, but with a series of quiet decisions that have fundamentally changed the nature of money. To truly understand the dollar's precarious position, we have to travel back in time. Imagine a world shattered by two world wars. Nations were desperate for stability, a way to rebuild and trust each other again. This desperation gave birth to the Bretton Woods Agreement in 1944. Leaders from 44 allied nations gathered in New Hampshire and created a new global financial order. At its heart was a simple promise. The US dollar would be the world's reserve currency, and its value would be fixed to gold at a rate of $35 per ounce. Other countries would then peg their currencies to the dollar. This was a brilliant move for America. It created a constant global demand for dollars. If France wanted to buy oil from Saudi Arabia, it first needed to acquire US dollars. This system, known as the gold standard, made the dollar as good as gold, instilling confidence and facilitating a post-war economic boom. For decades, it worked. The world rebuilt, trade flourished, and the United States sat comfortably at the center of it all, enjoying what former French Finance Minister Valéry Giscard d'Estaing called an exorbitant privilege. America could print money to pay its bills, knowing the rest of the world needed those very dollars to function. But this golden age had an expiration date. The U.S. was spending heavily, particularly on the Vietnam War and expansive domestic programs. The country was printing more dollars than it had gold to back them up. Other nations, particularly a savvy France, started noticing. They began exchanging their dollar reserves for U.S. gold, as was their right under Bretton Woods. A trickle turned into a flood. The U.S. gold reserves were plummeting. President Richard Nixon faced a choice: either enact painful austerity measures to shore up the dollar's value, or break the promise that underpinned the entire system. On August 15, 1971, he made his choice. In what became known as the Nixon shock, he unilaterally severed the dollar's link to gold. Money, for the first time in modern history, was no longer tied to anything real. It became fiat currency, backed by nothing more than faith in the government that issued it. This single act set the stage for the dollar's eventual decline. The world was now on a dollar standard, but it was a standard based on trust, not tangible value. And trust, as we know, is easily broken. The story of the dollar's decline isn't just a historical footnote. It's a living drama playing out right now. After 1971, the U.S. needed a new way to compel the world to hold dollars. They found it in oil. Through a series of agreements with Saudi Arabia and other major oil producers, they ensured that oil would be priced and sold exclusively in U.S. dollars. This created the petrodollar system. Any country that needed to buy oil, which was every country, had to hold vast reserves of U.S. dollars. This manufactured demand kept the dollar strong for decades, even as the U.S. ran up massive debts. But in recent years, this system has begun to fray. The key reason? The U.S. started using the dollar not just as a currency, but as a weapon. Through financial sanctions, the U.S. can effectively cut entire nations off from the global financial system. When Russia invaded Ukraine in 2022, the U.S. and its allies froze hundreds of billions of dollars of Russia's central bank reserves. This sent a shockwave through the world. Leaders in Beijing, Riyadh, and Brasilia all asked the same terrifying question. If they can do that to Russia, could they do it to us? Suddenly, holding massive dollar reserves looked less like a sign of stability and more like a massive liability. It was a strategic vulnerability. This fear has accelerated a global movement known as de-dollarization. It's not a coordinated conspiracy, but a rational response from nations seeking to protect their sovereignty. The BRICS nations, Brazil, Russia, India, China, and South Africa are now actively exploring trade in their own currencies. China has launched its CP system, a rival to the US-dominated SWIFT network for international payments. Saudi Arabia, the linchpin of the petrodollar system, is now openly discussing selling oil to China in yuan. Each of these moves, small on its own, is a crack in the dollar's foundation. So what does this mean for you and your money? This isn't some abstract geopolitical game. The decline of the dollar's dominance will have very real consequences for your financial future. First, expect more inflation. As global demand for the dollar wanes, the trillions of dollars held overseas will start to flow back to the US, chasing the same amount of goods and services. This is a classic recipe for rising prices. Your savings will buy you less, and the cost of living will continue to climb. Second, the exorbitant privilege will vanish. The U.S. has been able to afford massive government spending and trade deficits because the world was forced to lend it money by buying its bonds. As demand for those bonds falls, the U.S. will have to offer higher interest rates to attract lenders. This means higher borrowing costs for the government, for businesses, and for you on your mortgage, your car loan, and your credit card debt. A world that is less willing to finance American debt is a world where American prosperity becomes more expensive. In this shifting landscape, the old advice of simply working hard and saving dollars in a bank account is no longer enough. The very nature of money is changing, and you must adapt to protect yourself. The first step is to recognize that your cash is losing value. Holding large amounts of money in a savings account is like having a melting ice cube. You need to put that money to work. Your financial education is your greatest asset. Start by learning about different asset classes that have historically performed well during times of currency debasement. This includes real estate, which provides tangible value and rental income that can rise with inflation. It also includes equities owning a piece of a profitable business. A company that sells essential goods or services can raise its prices to keep pace with inflation, protecting your share of its value. But don't stop there. In a world where all fiat currencies are at risk, you must look beyond the traditional system. Consider owning hard assets that have intrinsic value and cannot be printed by a central bank. For centuries, gold and silver have served as the ultimate store of value, a form of financial insurance against chaos and currency collapse. Owning a small percentage of your portfolio in physical precious metals is not about getting rich quick. It's about preserving the wealth you've worked so hard to build. You've probably heard that a strong dollar means a strong America, right? It's like the backbone of global finance, keeping your savings safe and ensuring you can grab that morning coffee without breaking the bank. But what if that backbone is starting to wobble? Imagine waking up one day to find that the system that put the dollar on top is slowly being pulled apart. It could seriously mess with your retirement savings and even the price of your favorite latte. Think about it, if the dollar loses its grip, everything from your paycheck to your grocery bill could feel the pinch. It's a wild thought, isn't it? How would that change your day-to-day life? Consider Bitcoin as a potential non-sovereign store of value in a world where currencies are becoming more multipolar. It's like having a safety net. Diversification is key, folks. Don't just rely on one currency or asset class. Imagine spreading your investments across different countries, various asset types, and even different systems. It is all about creating a balanced portfolio that can weather the ups and downs of the market. So, how are you planning to diversify your investments? The world is not ending, but the world we have known for the past 80 years is. The unipolar moment, where the US dollar reigns supreme, is giving way to a more complex, multipolar reality. This transition will be volatile and uncertain. There will be those who are caught unprepared, who watch their savings and security erode because they clung to an outdated understanding of money. And there will be those who see the writing on the wall, who educate themselves, and who take proactive steps to build a resilient financial future. The choice of which group you fall into is yours alone. The game is changing. It's time to learn the new rules.